Silver didn't just rise today, it detonated. In a single trading session, it surged past $91, gaining over 4% in hours. That kind of move doesn't happen by accident. It happens when pressure has been building beneath the surface for months. What I discovered in today's data completely reshaped how I see the next move. There is one final barrier standing between silver and $100, and it is CES hanging by a thread. When it breaks, the move that follows won't be gradual. It will be fast, and almost nobody is prepared for how quickly it could happen. Most people looking at silver right now are reacting to the price. They see volatility, they see percentage gains, they see headlines. But they are missing the structural problem quietly tightening underneath the market. For 4 consecutive years, global silver demand has exceeded global mine supply. That means more silver is being consumed than produced. Industrial applications, solar panels, electronics, electric vehicles, medical instruments, continue expanding. Meanwhile, bringing new mines online takes years, sometimes decades. When demand exceeds supply in any market, inventories shrink. That's exactly what is happening. Exchange vault holdings, the metal backing futures contracts, have been steadily declining. Registered inventories, the silver immediately available for delivery, have fallen sharply in recent weeks. And here's the critical detail. The decline is accelerating. This isn't retail coin buyers clearing out shelves. This is institutional scale movement of physical metal. Large entities are choosing to take delivery instead of rolling contracts forward. In other words, they don't want paper exposure. They want the actual bars. That matters because futures markets function on confidence. Contracts are promises. Those promises assume that if enough participants demand physical delivery, the metal exists to meet that obligation. When inventories fall while open interest remains elevated, tension builds. At the same time, international pricing discrepancies are widening. Asian exchanges are trading at significant premiums over Western spot prices. In a balanced market, arbitrage closes those gaps quickly. When gaps persist, it often signals logistical constraints, regulatory friction, or tight physical supply. Yet, despite these signs, many analysts still frame silver's rise as speculative enthusiasm. But speculation doesn't drain vaults. Speculation doesn't cause sustained physical premiums. Speculation doesn't create multi-month uptrends and moving averages without interruption. The real issue is this. There may not be enough readily available silver in the system to satisfy both industrial demand and financial demand at current price levels. And markets have only one long-term solution when supply tightens and demand refuses to slow. Price must adjust upward until equilibrium returns. The question isn't whether silver can move higher. The question is how far it must move before the shortage pressure finally releases. There's one price level everyone is watching right now, $92. Technically, it's the last major resistance before $100. Psychologically, it's the gatekeeper. Historically, silver has hesitated there before. Traders see it, algorithms see it, short sellers defend it. But here's what makes this moment different. This rally isn't chaotic, it's structured. Silver broke above the mid-80s, consolidated. It pushed into the high 80s, paused again. Now it's pressing into the low 90s. And each consolidation is occurring at a higher floor. Pullbacks are shallower. Buyers are stepping in faster. Volume expands on up days and contracts during dips. That's not exhaustion, that's accumulation. Meanwhile, the 50-day moving average has been climbing for months without turning down. Sustained momentum like that is rare in commodities. It signals persistent demand absorbing every sell-off. But the technical picture is only half the story. The real catalyst may not be visible on the chart at all. Institutional delivery requests are increasing. Physical inventories are decreasing. Asian exchanges are pricing silver significantly above Western benchmarks. Industrial metals across the board, platinum and palladium included, are showing strength. And gold? Relatively quiet. That divergence matters. When industrial metals lead while gold lags, it suggests demand driven by manufacturing and real-world consumption, not just monetary fear. Now layer and geopolitical tension, any instability in energy-producing regions, adds risk premiums to hard assets. Not the primary driver, but an accelerant. So here's the setup. Shrinking inventories, rising institutional delivery, persistent price premiums overseas, industrial demand strength, a technical breakout forming, all converging at the same moment. If $92 breaks decisively, there's very little historical resistance between there and $100. And when round numbers like $100 fall in commodities, momentum often feeds on itself. The next section connects every data point together and explains why this may not just be another rally. It could be the early stage of repricing. To understand what is happening right now, we need to step back from the flashing price quotes and look at the sequence of events that led here. Silver didn't wake up one morning and decide to rally. This move has been building quietly for months beneath the surface, long before most traders noticed the breakout above $90. At the beginning of the year, Silver experienced a violent surge that pushed it toward extreme highs. The rally was fast, emotional, and aggressive. And then, just as quickly, it collapsed. Prices plunged. Commentators declared the move over. Weak hands sold into fear. Margin requirements were raised, leverage unwound, and paper contracts flooded the market. On the surface, it looked like a failed breakout. But underneath that chaos, something critical did not change. The physical market never loosened. Industrial demand did not suddenly disappear. Solar manufacturers still required silver paste for panels. Electronics producers still needed conductive materials. Medical technology companies still depended on its antimicrobial properties. The green energy transition did not pause. Electric vehicle production did not halt. Consumption remained steady. At the same time, global mine supply did not surge to meet demand. Mining projects take years to develop. Permits, environmental reviews, capital expenditure, labor, and logistics create long timelines. You cannot simply flip a switch and produce millions of additional ounces overnight. So while the paper price fell sharply during that correction, the structural imbalance between supply and demand remained intact. That is where the story truly begins. Over the following weeks, something subtle but powerful happened. Each dip in price was met with buyers stepping in faster than before. The corrections grew shorter. The recoveries became stronger. What looked like volatility on a chart was actually accumulation taking place. Then the vault data started shifting. Registered silver, the category of metal immediately available to satisfy delivery requests, began declining at a faster pace. Millions of ounces moved out within weeks, and notably, there was little evidence of large inflows replacing what left. In futures markets, most participants roll their contracts forward before delivery. They maintain price exposure without taking possession of the underlying metal. That is standard practice, but increasingly, more participants chose to stand for delivery. That decision changes everything. When an institution chooses physical settlement, it is signaling that owning the metal matters more than maintaining a leveraged paper position. It requires capital, storage, logistics, and commitment. It is not casual speculation. Recently, delivery data revealed that one major U.S. financial institution accounted for nearly all the delivery issuance on a single day. On the receiving side were other globally significant banks. These are entities with access to sophisticated modeling, proprietary data, and deep market insight. When banks of that size move physical metal in volume, it demands attention. Simultaneously, pricing behavior overseas raised additional questions. On Asian exchanges, silver traded at a meaningful premium to Western spot markets. In efficient markets, such price gaps are typically arbitraged away. Traders buy where it is cheaper, transport the commodity, and sell where it is more expensive. But the premium persisted. That persistence suggests constraints, whether logistical bottlenecks, export frictions, strategic accumulation, or limited availability of large bars in deliverable form. Meanwhile, other industrial precious metals began strengthening. Platinum recorded significant daily gains. Palladium followed with strong upward movement. Silver advanced alongside them. Gold, however, remained comparatively subdued. That divergence matters because it helps isolate the driver of the rally. If currency weakness or monetary fear were the primary catalyst, gold would likely lead the advance. Instead, metals heavily tied to industrial production are outperforming. That points toward tangible demand rather than purely financial speculation. As these factors converged, the technical structure of the chart improved. The 50-day moving average has been rising steadily for months. That signals persistent buying pressure. Each consolidation has formed at a higher price level than the previous one. Pullbacks are shallower. Support levels are respected more consistently. Markets that behave this way are not showing exhaustion. They are building energy. Now add timing to the equation. Major futures delivery months force participants to make decisions, roll contracts forward, or take physical silver. Even when substantial volumes roll into future months, the absolute level of registered inventory continues to trend downward. That means some percentage of traders consistently chooses delivery. And here's where psychology enters. If market participants begin to believe that inventories are becoming uncomfortably tight relative to open interest, they may act preemptively. Traders front-run potential shortages. They buy before the squeeze fully materializes. That behavior itself pushes price higher, which in turn attracts additional momentum participants. It becomes self-reinforcing. On top of that, geopolitical tensions introduce uncertainty into global trade flows and energy markets. Precious metals often benefit from even modest risk premiums during such periods. While geopolitics alone is not driving this rally, it acts as an accelerant layered onto existing supply constraints. All of these threads weave together into a single narrative. A structurally undersupplied market, declining readily deliverable inventories, increasing institutional preference for physical settlement, persistent international price premiums, industrial demand leadership across related metals, technically strengthening price action. None of these factors alone guarantees an explosive move, but when multiple independent indicators point in the same direction, probability begins to shift. This is not the story of a speculative frenzy detached from fundamentals. It is the story of a commodity whose real-world consumption has quietly exceeded its replenishment rate for years. Eventually, markets reconcile imbalances, sometimes gradually, sometimes violently. Right now, silver appears to be approaching a decision point where technical resistance meets fundamental pressure. If the ceiling holds, consolidation continues and the pressure builds further. If it breaks, the repricing phase accelerates. Either way, the forces beneath the surface are no longer subtle. They are visible in the vault numbers, in delivery reports, in cross-market strength, and in price structure itself. And that is why this moment feels different from the brief spike earlier this year. This time, the foundation looks stronger. The rally is not floating on enthusiasm, it is standing on tightening supply. And in commodity markets, tightening supply is rarely ignored for long. Now let's bring everything together. The question isn't simply whether silver can touch 92. The real question is whether that level can withstand the kind of structural pressure currently building underneath this market. Technically, $92 is resistance. Charts shows prior hesitation around this zone. Traders recognize it, short sellers defend it, algorithms react to it. On paper, it looks like a ceiling, but fundamentals don't care about lines on a chart. Right now, the underlying data is pointing in one direction: tightening supply, meeting persistent demand. Registered inventories have been trending lower at a pace that cannot be ignored. Physical delivery requests remain elevated. Large financial institutions are opting for metal rather than paper exposure. International exchanges are valuing silver meaningfully higher than Western spot markets. Those are not random signals. They are pieces of a larger pattern. When physical supply contracts, while demand remains steady or grows, price becomes the balancing mechanism. Markets adjust upward until either new supply enters the system or demand is destroyed through higher costs. At this moment, there is no immediate surge in new mine production coming online. Mining expansion operates on multi-year timelines. That means the adjustment variable, in the short to medium term, is price. If silver pushes decisively through $92, there is relatively little historical resistance between that level and $100. And $100 is not just another number, it is psychological. Round numbers change behavior. At $100, silver becomes headline material again. Mainstream financial media begins coverage. Retail investors who ignored the move at $85 suddenly pay attention. Exchange-traded funds could see renewed inflows. And when ETFs expand, they must acquire physical metal to back new shares. That tightens the available pool further. Momentum also feeds on itself. Breakouts above well-defined resistance levels often trigger systematic buying from technical funds. Stop losses on short positions get activated. Buying pressure compounds. However, no analysis is complete without acknowledging risk. The most immediate risk is margin adjustment. When commodities rally rapidly, exchanges sometimes raise collateral requirements. That forces leveraged traders to either add capital or liquidate positions. In the past, such moves have triggered sharp, short-term corrections. A 10-15% pullback would not be structurally surprising in a volatile commodity. It would feel dramatic, but it would not erase the broader supply-demand imbalance. Another risk is geopolitical cooling. If global tensions ease, a temporary risk premium could fade. Yet the current rally began before geopolitical headlines intensified. That suggests geopolitics is additive, not foundational. And of course, markets can stall. Resistance can hold longer than expected. Consolidation may extend before the next decisive move. But here's the key point. Every major fundamental indicator currently aligns. Supply deficits persist, deliverable inventories shrink, institutional players take possession, industrial metals broadly show strength. International pricing implies tightness. When technical resistance stands against a strengthening fundamental backdrop, history often favors fundamentals, eventually. That doesn't guarantee a straight line higher. It means that if silver sustains a breakout above $92 and begins stabilizing above $100 for more than a brief spike, the market may be entering a new pricing regime. In that scenario, prior highs become reference points rather than ceilings. The difference between a temporary rally and a structural repricing is duration. If silver can hold elevated levels for weeks instead of days, it confirms demand strength rather than speculative excess. Right now, the data does not suggest exhaustion. It suggests pressure. And pressure in markets resolves in one of two ways. Supply expands, or price rises high enough to ration demand. At this stage, expanding supply quickly is unlikely, which leaves price. That is the reveal. Not hype, not emotion, just arithmetic. When demand exceeds supply long enough, the adjustment becomes inevitable. Now, I want your perspective. Do you believe $92 breaks cleanly this week? Or does the market reject it once more before regrouping? Are you watching the technical chart more closely? or the vault data? Because this moment sits at the intersection of both. If you follow silver, monitor delivery statistics, exchange inventories, and international premiums over the next several sessions, those indicators may provide earlier signals than price alone. Share your view. Is $100 inevitable in the near term? Or does volatility shake out weak hands first? Healthy debate strengthens analysis. And if you found value in this breakdown, data-driven, no hype, consider sharing it with someone who tracks commodities. The more perspectives we gather, the clearer the larger picture becomes. Markets reward preparation, not reaction. Let's return to where we started. Silver didn't just rise, it surged with intent. Behind that move wasn't excitement, it was structure. Shrinking supply, persistent demand, institutional delivery, international premiums, industrial strength, all pressing against one final technical ceiling. $98 is not just a number, it's a threshold between awareness and acceleration. If it falls, the sprint toward $100 may unfold faster than most expect. If it holds temporarily, the underlying forces do not disappear. They continue building pressure. Either way, the real story isn't the daily percentage move, it's the imbalance underneath. Because in markets, just like in physics, pressure doesn't vanish, it transfers. And right now, all signs suggest that pressure is transferring into price. Stay observant, stay analytical, and most importantly, stay focused on the data.